Now we are in stage 2, where we are going to determine the required retirement capital or lump sum required, and in this case we can use capital liquidation method, where in this capital liquidation method the lump sum required refers to the total amount of fund that we are required to meet the yearly retirement income for the number of years during retirement phase, which means if the retirement period is 30 years, at the end of 30 years there will be the balance of the retirement fund will be zero, which means there will be no money left either for us or for our children. So which means if the client can live for another 30 years from the date he retire, the lump sum of money, the fund or the retirement fund that we set must be able to cater for that particular 30 years only. I'll give you an example of capital liquidation without inflation. In this case, Mr. Ali decided to adopt a capital liquidation approach in retirement planning, and below are some variables and assumptions in Mr. Ali's retirement planning. And here is basically the information given to you. The first year annual retirement income is set to be 100,000. The rate of return in retirement is 5%. Number of years expected in the retirement phase is 20 years, and the inflation rate is 0%. And this is actually the formula for capital liquidation method. Alright, so this is the formula, and during exam the formula, all of the formula will be given to you, especially during the professional exam. Okay, so what actually means by this formula? The PV means the lump sum required for retirement. This is what we want to get basically. A is actually the first year annual retirement income. This is the payment that should be paid to the retiree each year. The rate of return of retirement account is the return from the saving or the return from the retirement fund is about 5%, and number of years in the retirement phase is 20 years, as in this case of Mr. Ali. Therefore, if we apply this formula, okay, and we include all of this number, then we can get here 1308510. And you can also use your financial calculator to solve for this. You set begin, and it's 20i equal to 5. PV is actually the one that you are going to solve. PMT is 100,000, future value is 0, PY and CY is 1. Okay, compounding is 1 in a year. Okay, and the payment per year is just 1. PY means that the payment made in a year is just once, and the compounding per year is also 1. Okay, so once you solve, you go to PV and you solve this information, then you can get this figure, which is quite close to the one in this answer. If you check the answer here, 1308532, and the answer that you use the formula 1308510, there's a slight differences. Okay, a slight difference between these two answer. However, this is particularly very normal, where the answer from the formula and calculator just a little bit different, so it is considered as accepted.